Elon Musk reveals that the US economy has collapsed. According to Musk, soon a lot of bad things will happen because the US economy has collapsed and people should know what is really going on in the USA. This is a crazy story development. So let's explain how Elon Musk reveals that the US economy has collapsed. So, the United States, with a population exceeding 330 million, is a melting pot of ethnicities, cultures, and languages, reflecting its history as a land of immigration. The country boasts the largest economy in the world, with a gross domestic product, GDP, surpassing $20 trillion. Additionally, the US is home to some of the world's largest and most influential corporations, particularly in the technology sector, such as Apple and Microsoft. In comparison, China, with a GDP of over $14 trillion, is the second largest economy globally, and the European Union, considered as a single entity, also ranks among the largest economies, with 15.9 trillion euros GDP. But in size, none of them compare to the USA for many years already. So what has happened? How this giant economy has collapsed? Well, Elon Musk is openly worried about the US economy. He describes it in a very negative way, using strong words. He compares the recent problems of Silicon Valley Bank and Credit Suisse to warning signs, like miners dying in a mine, showing that the economy is in big trouble. He thinks the Federal Reserve is acting too slowly by raising interest rates to fight inflation, which could make things worse. Musk expects a very difficult year ahead and thinks we might face a big recession if the Fed doesn't change its approach. And one of the biggest reasons why US economy has collapsed is that the United States labor market has faced several challenges, many of which have stemmed from the aftermath of the COVID-19 pandemic and ongoing global economic shifts. A significant issue has been the labor shortage in various sectors, notably in healthcare, education, and hospitality. This shortage has been partly due to demographic changes, such as the aging population and lower birth rates, leading to a smaller workforce. Additionally, the pandemic has accelerated retirements and prompted a re-evaluation of work-life balance among many workers, leading to what has been termed the Great Resignation. This phenomenon has seen a record number of people voluntarily leaving their jobs, driven by factors such as the desire for better pay, improved working conditions, and more flexible work arrangements. Furthermore, disruptions in global supply chains and the rapid shift to remote work have also contributed to mismatches in labor supply and demand, with some industries struggling to adapt to these new conditions. The consequences of these labor market challenges have been multifaceted. For businesses, particularly small and medium-sized enterprises, the struggle to find and retain qualified staff has led to operational difficulties and hindered growth potential. This situation has often resulted in increased wages as companies compete for a limited pool of workers, contributing to inflationary pressures in the economy. On the other hand, workers have experienced both positive and negative outcomes. Additionally, the mismatch between the skills of the workforce and the needs of employers has highlighted the need for significant investments in training and education to prepare workers for the evolving demands of the modern economy. Also, one of the biggest reasons why US economy has collapsed is that the United States has faced significant challenges related to interest rates, primarily influenced by efforts to manage inflation and economic growth. The root of the issue has lain in the economic response to the COVID-19 pandemic, during which the Federal Reserve, the US central bank, has lowered interest rates to near-zero levels to support the economy. This monetary policy, coupled with substantial fiscal stimulus, has been aimed at bolstering consumer spending and business investment during the unprecedented downturn. However, as the economy has begun to recover and consumer demand has surged, these policies have contributed to rising inflation. By 2022 and into 2023, the US has been experiencing inflation rates not seen in several decades, prompting the Federal Reserve to reverse course and start raising interest rates in an attempt to cool down the economy and curb inflation. The impact of rising interest rates has been felt across various sectors of the economy. For consumers, higher interest rates have meant more expensive borrowing costs, affecting everything from mortgage rates to credit card interest, thereby reducing disposable income and potentially slowing consumer spending. This situation has particularly impacted the housing market, where increased mortgage rates have begun to cool off the previously booming demand for homes, leading to a slowdown in real estate price growth. For businesses, the cost of borrowing has increased, potentially leading to reduced investment in expansion and hiring, which could slow economic growth. On the financial markets front, higher interest rates have typically led to adjustments in stock and bond prices, often resulting in increased market volatility. While these measures have been necessary to tackle inflation, they also carry the risk of tipping the economy into a recession if not managed carefully, highlighting the delicate balance central banks must maintain between fostering economic growth and controlling inflation. With that, one of the biggest reasons why U.S. economy has collapsed is that inflation problem has been very tough on economy. The consequences of this inflationary period have been widespread and multifaceted. For the average consumer, the increased cost of living has eroded purchasing power, as wages in many sectors have not kept pace with inflation. This situation has particularly impacted lower and middle-income families, who spend a larger proportion of their income on necessities like food, housing, and transportation. In response to rising inflation, the Federal Reserve has been increasing interest rates to cool down the economy, a move that carries its own set of risks, including the potential for economic slowdown or even a recession. Businesses have faced challenges too, including increased costs for materials and labor, and the need to adjust pricing strategies, which could dampen consumer demand. The inflationary environment has also created uncertainty in financial markets, affecting investment decisions and retirement savings. Overall, the inflation problem has underscored the delicate balance required in economic policymaking and the interconnected nature of global economic systems. And that's it for today. Subscribe to our channel and hit the notification bell.